Hello and welcome to the lecture for Chapter 1. In this chapter, I'm going to kind of start with the big picture, talk about what accounting is, how it relates to business, how the two interrelate. Talk a little bit about generally accepted accounting principles, which are the rules that accountants follow. I'll talk about the accounting equation, which is a fundamental, foundational kind of thing for understanding accounting, so that's really important that you get that. Talk about how transactions affect that accounting equation, and then we'll do a quick overview of financial statements so you can see what they look like. So first, some important definitions. First of all, what is a business? So a business is any organization in which basic resources are used, which would be like materials, inventory, labor, things like that, to provide goods and services which are outputs to customers. So it could be a for-profit business. So that's a business that seeks that their outputs exceed their inputs so that they earn profit. That's the difference between revenues and expenses. It could be a service business, which is a business that provides, as it sounds, services to customers. That would be like a dentist office or a law firm or a CPA firm, those consultants, that sort of business. It could be a merchandising business. That would be a business that buys and sells products without altering them. So an example of that would be the college bookstore or Walmart or the dollar store, those kinds of businesses. And then lastly, we've got manufacturing businesses, which from an accounting perspective are the most complicated, and they create products. So they buy raw materials and convert them into finished products that they then sell to customers. Many businesses are a combination of all three. I used to own a business, and in my business, we were primarily a manufacturing business, but there were also some services we provided to customers, and there was also some merchandising aspects, things that we bought from other companies and just turned around and resold them. So some more accounting or some more important definitions. One, accounting, it's an information system that takes all of the transactions that flow through a business, which even a small business could have hundreds or thousands of transactions in a month. So taking all of those transactions, capturing them, and then arranging them in a way that tells a coherent, meaningful story to the people that have a stake in the business, users of financial statements. There's two different areas of accounting. So one is managerial accounting. That's the kind of accounting that's done within a company to provide answers to the people that are running the company, so the management of the company. So that would be which product line is most profitable, which group of employees is productive, which is not, those kinds of things. Budgeting, cost analysis, all of that. The other type of accounting is financial accounting, and that focuses on providing information to external users of financial statements. So the owners of a company, people that have lent the company money, the state and federal government, for tax purposes, all of that. So financial accounting is focused outside the company. And in this class, we'll focus on financial accounting. So when you take, and that covers Accounting 201 and 202, Accounting 203 will cover managerial accounting. So the whole process of creating an accounting system, it starts with identifying who the users are. And again, those users could be internal or external users. So what information do they need in order to be able to make good decisions? That's the key thing. And that's always going to be changing, right? As the business environment changes, as how you do business changes, the needs of the stakeholders in the business change as well. So the second step is, well, first is identifying the users. Second step is identifying what information they need. The third is design an accounting system that captures that information and reports it back in an efficient, timely, and accurate way. Step 4 is recording economic data, so recording those transactions. And then 5 is preparing the accounting reports, so issuing the daily or weekly or monthly, whatever period of time is in question, delivering that to those users. And then you can see it's a loop there. So you're always identifying new users, adjusting what they may need to know. Again, it's an evolutionary process. So some things about accounting jobs, if this is something that interests you and you might want to make a career out of it, there are kind of two paths to go down. There is private accounting. Those are people that work inside companies, government entities, not-for-profit entities, all of that doing the actual accounting work. You can see they include a lot of different kinds of things from bookkeepers all the way up through what would be a controller or a CFO in the company, chief financial officer. Generally, the difference between bookkeepers and accountants, bookkeepers have their hands on transactions, they're billing customers, recording payments from customers, recording purchases from suppliers and payments to suppliers, processing payroll, all of that. And accountants are the ones that gather that information and produce meaningful reports and make some adjustments to make things more accurate. The other path to go down is public accounting. You've probably heard of CPA firms. CPA firms primarily offer three different kinds of processes or services for their customers. One is, of course, doing tax returns. You probably are familiar with that. So doing tax returns for individuals or for businesses or other kinds of entities that are required to file tax returns. Another aspect is auditing, and auditing is a whole class unto itself that you could take, and it deals with going into a business and doing testing to arrive at an opinion about whether or not the company's financial statements are accurate and correct. So users of those financial statements will often ask for some independent third party, a CPA firm, to come in and audit the books so that they know what they're looking at is accurate and hasn't been fudged in any way. And then the third area of public accounting is consulting work. So the salaries listed here are a little bit out of date. Right now, a starting CPA or a starting accountant at a CPA firm in Seattle starts at about $80,000 a year in salary, and in the Olympia area it's closer to $70,000. So generally accepted accounting principles, that's often referred to as GAAP, G-A-A-P. If you hear me say GAAP, that's what I'm talking about. And those are rules that are in the United States that all accountants agree to abide by in terms of producing external financial statements. The reason for that is it gives us consistency over time and comparability between companies if we're following the same rules. So the Financial Accounting Standard Board is the group that creates those principles and updates them from time to time. They are given that authority by the Securities and Exchange Commission, a branch of the federal government. And that's in contrast to the International Accounting Standards Board. So in the US, we follow GAAP. Everywhere else, they follow international financial reporting standards. These principles are based on four underlying concepts. One is the business entity concept. That means that we're only going to record transactions for the business itself, not the owner's personal life. Next, the cost concept. Everything we record is going to be recorded at historical cost, so we're not going to factor inflation in or anything like that. Objectivity means we're not going to try to make things look good or make things look bad. We're not going to try to be optimistic or pessimistic, but realistic. And then the last unit of measure, everything that we report will be in US dollars. So we may do business in other currencies, but we'll convert those to US dollars before we report. So here's the accounting equation. And like I mentioned, this is a fundamental kind of thing. So on one side of this equation are the assets. That's everything the company owns. So it might be buildings and land and equipment and computers and machinery and cars and trucks, those kinds of things. So what does the company own? The other side of the equation is what are the claims on those assets. So if the business stopped today and we had a yard sale and converted everything we owned into cash, who would get the cash? And the first in line would be our liabilities. That's another word for debts or obligations. That's money that we owe to other people. Maybe our suppliers, maybe our employees for payroll, maybe the government. So we have a whole range of different liabilities a business might have. And then the owners have a claim, of course, on the net assets of the business. So they also have a claim there. So every time we have a transaction, that equation is going to stay balanced. So a business transaction is an economic event that directly changes the financial position or the results of the company. So getting an order that is going to be fulfilled in a month is not a business transaction. It didn't change our financial position. Fulfilling that order changes our financial position. So every transaction, and I don't care what kind of transaction you can think of, it's going to increase or decrease one or more of the elements of that accounting equation, but the two sides are always going to be equal. The owner's equity is going to be increased by investments the owner makes, it's going to be decreased by withdrawals, and it's going to be increased by revenues and decreased by expenses. So with profits being revenues minus expenses, profit increases owner's equity and losses decrease it. So I'd like to take a look at the financial statements, and we're looking at financial statements for a sole proprietor. So a very simple kind of business with one owner, and that's kind of what we'll focus on until we get a little further in the class. So the financial statements at the end of any period, a month or a year, need to be done in this particular order. First, we do the income statement. The income statement is revenues minus expenses for a period of time. That'll tell us, did we make money or not? The statement of owner's equity is a summary of all the changes in the owner's claim to the business. So did they make investments? Did they make withdrawals? Were there profits? Those kinds of things. So it's a reconciliation of the owner's claim on the business, again, over a period of time. The third one, the balance sheet, is a listing of basically the accounting equation. What are all the assets the business owns? What are all the liabilities that it owes? And what's the owner's equity as of a specific date? So this isn't over a period of time. This is as of a date. What is the picture? And then lastly, the statement of cash flows, that shows where cash came from and where cash went to during a period of time. Let's take a look at the first one here. So in this simple income statement, the first thing you'll notice is that there's a header at the top. Those headers are always in this format where we have the name of the company, in this case, Net Solutions. Second line item is what are we looking at? This is an income statement. And then this is really important, the period of time we're talking about. If that third line didn't exist there, I wouldn't know if this was for last week or last year or who knows what. So this was for the month ended November 30th. And this business had revenue, which they called fees earned, of $7,500. And then they have expenses. So this business had 6 different categories of expense that they recorded of $4,450 for that month. So I take their revenue of $7,500 minus their expenses of $4,450. They have net income of $3,050. The next one, again, is the statement of owner's equity. So this says that their capital of the owner, Chris Clark, started out at 0. Again, this appears to be their first month in business. The month ended November 30th. He made an investment of $25,000. That increases it. Earned net income of $3,050. That came from the income statement, so we needed to do the income statement before we did this. We subtract withdrawals of $2,000, and that gives us the ending balance of $26,050. This is an important statement to look at if you're thinking about lending money to the company, because you would prefer to lend money to a company where the owner isn't taking all of the available cash out of the business. So looking at this would tell you that. Next one, the balance sheet. Again, see the header's a little bit different here. It's as of a particular date, not for a period of time. And I've got assets, so I've got cash, supplies, and land, $26,450 of assets. For liabilities in this business, I've got $400 in accounts payable. That's what I owe my suppliers. And that $26,050 for the owner's claim on the business. And again, that came from my statement of owner's equity. I wouldn't have had that if I hadn't done that first. I wouldn't have that number. So it's very important here. You see total assets, $26,450, have to equal total liabilities and owner's equity of $26,450. Those two numbers have to be equal to each other, or we've made a mistake somewhere and we need to try again. The last one, the statement of cash flows, and we'll cover this, you'll cover this in Accounting 202 in greater detail, but it's going to show 3 different categories with regards to cash going in and out of the business. The first category is operating activities. That's what happened with the core purpose for which we're in business. If we're providing services to customers, what cash was generated by that activity and what cash was used up by that activity. That gives us a net total. Did it generate cash or did it use up cash? In this case, it generated $2,900 in cash. Then we have investing activities. That's buying long-term assets. So buying things that are going to be around for a while. That's where cash goes to. Cash comes from selling those kinds of things. So did I get cash by selling a truck or a building? Did I use cash for buying land? In this case, they used $20,000 in cash for buying land. Then the third and final category is financing activities. That's everything to do with long-term debt and the equity in the business. So owners putting money in or taking money out. So in this case, there was money that was put in by the owner, money that was taken out by the owner. So the net cash flow from financing activities was a positive $23,000. And then that tells us the increase in cash, $5,900. The thing that's important here is looking at the operating activities. That tells us if the business is sustainable or not. Any business where their operating activities are using cash, that obviously can't go on forever. So that is the end of the lecture for Chapter 1. I look forward to speaking to you when I lecture on Chapter 2. Thank you.